Morning. Welcome to this year's 2024 year-end tax planning seminar. My name is Andrew Thompson. I run our wealth management division here at SC&H, and we're pleased to have you join us today. We've got a number of things to get to. I will tell you there's some good news, bad news. Bad news, the Department of Government Efficiency, or DOGE, is not fully operational, and the U.S. Department of Treasury will, in fact, be operating this year. But the good news is we've got a great team of people who are going to show you some tax mitigation strategies, some considerations to reduce that tax bill. So let's get to it. A couple of reminders. All attendees will be muted during the webinar. Webinar will be recorded. It's going to be shared within about a day or two. We've already gotten a bunch of questions. Feel free to submit those during the broadcast in the questions tab that you see on your screen, and we will do our best to get to them, time permitting, so bear with us. We've got a lot of things on the agenda today. We're going to be talking about a bunch of different topics, everything from individual tax planning to some things on the small business planning side, as well as some corporate considerations as well. And then we're going to wrap up with the Q&A that I promised. And again, we will do our best to get to everything today. If there are questions that you really want to make sure are getting answered, our contact information will be at the end of the slides as well. Please feel free to reach out to any of us. Our speakers today be myself, Michael Bondi, who's a director in our tax department, James Eaton, another director, Dan Gartrell, who's a principal, Zach Landon, who's a principal, and Liz Wilcom, who's a tax supervisor with SC&H Wealth. We're going to kick it off with some personal tax and financial planning considerations. And one of the things that I wanted to start with is something more on something that's a little more time sensitive. As we go into the end of the year, something that I always talk about in these presentations, because it for people who own these types of investments, it has such a meaningful impact on what you're keeping after paying tax at the end of the day. And specifically what I'm talking about are mutual funds. And then if we take it a step further, mutual funds that are actively managed, those types certainly more than a passive mutual fund, tend to pay out year-end capital gain distributions. It's the way they're structured. And the challenge here for shareholders of these mutual funds is if you are an owner of the fund on the record date, which is announced in advance by the mutual fund company, you are going to be susceptible to any of the year-end capital gain distributions that they distribute to their shareholders. So for example, if you own $100,000 in a mutual fund, regardless of if it's up on the year or down on the year, regardless if you sold anything during the year, if they're distributing a 10% capital gain distribution, that means that there's going to be a $10,000 capital gain that you are going to be responsible for. Now, you have some options here. And one option is, of course, to get out of the fund before the record date. Now, that may not always be a realistic option, especially if you're sitting on a lot of gains on your position. But consider if the capital gain distribution that's announced is 10%, and your gain is maybe 15%. So you're still going to pay more than what you would pay if you realize the gain distribution. But think about future years. If you get out now, you'll pay a little bit more up front, but you will avoid future capital gain distributions, assuming you take the proceeds and put it in something that may be a little more tax efficient, such as an exchange traded fund or an index fund that's in a mutual fund wrapper. Okay, those tend to be a lot more tax efficient. If you're unsure, please contact myself or other people on our team. We'd be happy to talk you through some different options based on your unique set of circumstances. Asset location matters a lot. What I'm talking about here is the type of account that you own these securities in. And so, for example, if you're going to own something like a bond, own it in something that's tax deferred, like a retirement account, 401k, TSP, 403b, IRA, Roth IRA, because most of the returns that it's going to receive for that type of investment is going to be interest income, ordinary interest right? Ordinary income. That's taxed at the highest tax rate. Well, it's taxed the same as other types of income like earned income, as opposed to, say, preferential treatment on capital gains and dividends. So if possible, if you're going to own that type of security, own it in a tax shelter type of an account, like a retirement account, and put your more tax efficient investments in your standard brokerage account. Yes, you read that right. So what I'm talking about here would be something like hedge funds, private equity, venture capital, all have, they're kind of mysterious to a lot of people. They operate a little bit behind the curtain. The reason I say these are trouble, and I'm not saying don't invest in them, okay, because there are many types out there that are going to be phenomenal investment opportunities. The challenge is on the tax side. These generate a K1 by and large. And K1s can be challenging because they don't tend to be released until the March timeframe, sometimes April, sometimes even after that. So if you do have an investment in one of these, there's a high likelihood that, number one, whoever your tax preparer is, they may not be happy with you. Second thing is that you may be on extension, because if they don't get the information in time, you're going to have to be extended, which for some people, that's not a big deal. For a lot of people, it is. It also is going to increase the cost of your tax preparation because there's more time involved in putting together the information from the K1 onto your 1040. And the last thing I'll mention, on these types of investments, I will say it is very difficult to figure out what your actual net rate of return is. It's not as simple as, say, if you owned an index fund or an individual stock. It's very difficult to really figure out whether or not your investment experience was positive or not. So just buyer beware. I'm not saying to avoid them completely. It's a good segue into what I'll call cryptomania. Certainly been getting a ton of headlines lately, and that's why I brought this up this year. A lot of people are talking about crypto, whether it's Bitcoin or Dogecoin or some of these other meme coins that are out there. But one thing to keep in mind is there is an opportunity here. I'll sort of put it in quotations, a loophole. Right now, as we understand it, the IRS considers crypto to be property as opposed to a security. And that means it's not subject to the same, what's called a wash sale rule, as if you owned an individual stock. And what that means, if you own crypto, and let's say you own Bitcoin and you bought it at, today, I think it hit 100,000, believe it or not, and it drops to 90,000. Okay, so you bought it at 100, drops to 90, you have a $10,000 unrealized loss. So if you were to sell that and realize the loss, you could buy it back the same day. Okay, and if it goes up from there, it's not going to be a disallowed loss. If that was a security, it would be a disallowed loss because you didn't wait the 31 days before repurchasing that same security. Okay, now Congress is talking about this. There was some efforts to reclassify that to get rid of this opportunity. Now, right now, because crypto has gone into the stratosphere from a pricing standpoint, there's probably not a lot of people who are sitting on loss opportunities. But if that does come up for you, please note that as of now, I believe that there is an opportunity to avoid the 31-day rule. Next year, we're seeing some increases in the retirement plan contribution limits. We've got a couple things going on that I wanted to talk about. So the first thing to note is the limits are increasing only about $500 if you're under 50 to $23,500. It was $23,000 this year. So we're seeing that jump up a bit. If you're over 50, you get to put in an additional $7,500. But here's what's interesting. In the Secure Act 2.0, they added this little additional funding opportunity for those between 60 and 63. Now it's 63 or 60 by the end of the year. So if you're 12/31 of next year, if you're in that range, you can put in 150% of the catch-up limit, which equals 3750. So you can put in 23.5 plus 7,500. And then if you fall into this 60 to 63 range, an additional 7,350. Pretty interesting. I don't ask me why they put that in there, but I think it's great they'll allow people to put in a little bit extra into their retirement accounts as they approach their retirement years. IRA, Roth IRA, no changes there from this year. 7,000 under 50, 1,000 over 50 for the 50 rule. As long as you're 50 by 12/31, you can make that additional contribution. There are some income limitations on that, so I'm going to talk about some opportunities to circumvent that. If you're a business owner, one thing to keep in mind, and some of our small business tax professionals can give you a little bit more detail here. If you have at least one W-2 employee, you must offer access to a retirement plan option. So go to marylandsaves.com for more information on that. All right, so let's talk about some advanced Roth funding opportunities. So for those who are you're filing a joint return with your spouse. If you make more than 236,000, you cannot contribute to a Roth IRA. 150,000 for single. And there are some workarounds here. The first thing I'll mention is you want to ensure you don't have any pre-tax dollars in an IRA, meaning you put money into an IRA, or you had money from a 401k, you rolled it into an IRA, you haven't paid tax on that money yet. That's why we call it pre-tax. So you took a deduction when you put it in. The IRS at some point is going to want that back. So the first thing you want to make sure of, if you do have any money in an IRA that's pre-tax, see if you can move it to a qualified retirement plan like your 401k, right? If you're a small business owner, something like a solo 401k, that circumstances are going to dictate whether or not that makes sense. It may or may not make sense. Consult with your wealth advisor to be sure. What you want to do then, that when you don't have any money in any pre-tax money in your IRA, you can then contribute the max 7,000 or another 1,000 if you're over 50 to the IRA. There's no deduction for it because you're going to then convert it to the Roth IRA. All right, so take a step back. No pre-tax money in the IRA. You're going to then put 7,000 into the IRA. No deduction. Convert it to the Roth. That circumvents the income limitation that would normally be on the Roth. So it's one way to get the money ultimately into the Roth IRA. And you do that over time. So in any one given year, it may not feel like you're making a lot of progress, but adds up. If you're married, that's 14,000 per year that you can put in, 7 for you, 7 for your spouse. Over 20 years, assuming average equity returns, that's $780,000 that you put into the Roth over 20 years. So picking up quarters off the street can add up sometimes. Now, to take it a step further, let's talk about what I call the mega indirect Roth funding strategy. So this is available to those who participate, number one, in something like a 401k or other qualified retirement account, which means for 2024, your contributions are the 23 and the 7,500 for those over 50. You want to make sure that your employer plan, for this strategy to work, that your employer plan offers after-tax contributions. A lot of plans don't because of non-discrimination testing. And if they were to offer it, their plan may fail testing, and it's a whole thing. So what you want to ask your HR department, or the powers that be, hey, does our plan offer after-tax contributions? Second thing you want to confirm is, does our plan allow in-service rollovers or conversions to a Roth 401k? What I would tell you is most plans, if you're over 59 and a half, most plans offer in-service rollovers, meaning you're active with the plan. Can you move money out of your 401k into an IRA or other type of account? If they don't offer that, most do offer a conversion to the Roth 401k. It's a feature in your plan. And If they're not offering that second piece, the latter piece, it's usually a pretty easy fix to add it in there. Next, keep in mind that to now get this done is you want to put in your max contribution. This is to take full advantage of this. So next year, that's 23.5. If you're over 50, the catch up, another 7,500. You're 60 to 63, that's the additional 3,750. And then you can put in an additional $46,000 on an after-tax basis. Remember, we want to confirm that the plan allows that. So now we've put a ton of money into the 401k, and a lot of it was on an after-tax basis. Well, your plan's going to allow you to separate the pre-tax and the post-tax dollars. So regardless if you put it in pre-tax, they're going to pull out what the after-tax portion was, and you can convert it to your Roth 401k. So think about that for a minute. You could put $46,000, regardless of your income limit, into your Roth 401k. And if it allows in-service rollover, you can pull out just that after-tax portion into the Roth IRA that you've established. So a lot of nuance there. I always recommend consulting with your wealth advisor to make sure that this is a situation that could work. There's a couple other ways to do this. I'm not going to get into it today for time purposes, but just please note that there's some really cool ways to add a significant amount of money into a Roth IRA, which means all of those earnings, at least under current tax law, and all of those contributions will be forever tax-free under current tax law. This isn't necessarily a year-end tax planning strategy, but I do want to mention it for those, because we hear this question a lot from our clients. If you have extra money in a 529 account, what are your options? What can you do with it? And a little known fact about what the Secure 2.0 Act did, and this is interesting because this was a Democratic Congress that did this. They opened up the opportunity for those with leftover money in a 529 to ultimately move over up to $35,000 into a Roth IRA for that beneficiary, provided a couple of conditions are met. So child either goes to school or doesn't go to school, regardless, you've got some extra money sitting there. You're like, okay, what do we do with it? You can ultimately move that slowly over to a Roth IRA. Here's how it works. So number one, you've got to have the account open for at least 15 years. Number two, the beneficiary must have earned income equal to the amount of the contribution. So you're going to be limited to the max, which is $7,000 for this year and for next year. So if little Johnny earns well, I guess it wouldn't be little anymore if he's out of high school. If Johnny earns $7,000, you can move $7,000 from the 529 directly to a Roth IRA in his name. And then you can do that until the 35,000 mark is hit. Okay, that's over 5 years, if my math is correct there. Another consideration, if it looks like you're going to be in for having excess money in your 529 account, you may use $10,000 towards K through 12 tuition. $10,000 a year. The last thing I'm going to touch on here is some effective ways to give. Now, this is very coming up at the end of the year, and I want to make sure that you've got enough time to get this done if you want to get it done. So some different ways to good. What I'll say is kind of a good, better, best here. Number one, if you give cash to charity, that's good. You're going to get a deduction. There are some limits on how much cash you can give relative to how much you earned, how much your AGI was throughout the year. That's a good option. A better option is if you gave stock to charity, and that's a way for you to avoid either capital gains on it, or if you wanted to diversify a little bit and get out of it, you can give shares of stocks. If you owned 100 shares of Microsoft, you could give, say, 35 shares and send it directly to the charity. Okay, work with your brokerage firm to help you do that. Fidelity makes it very easy. It's where we keep a lot of our client money. Schwab's another place that makes it very easy to move shares of stock directly to the charity. You get a deduction equal to the amount of the value of those shares on that particular day. And then the best way to do it would be to not only give the stock, but if your normal giving is, say, $10,000 per year, that's what you typically give in a year. And let's say this was a good year from a business standpoint, and you've got more income this year than you're going to have next year in all likelihood. One thing to consider is to give maybe the next 3 to 5 years into this year and put it into what's called a donor advised fund. Okay, all the big brokerage houses have these things, donor advised funds. In and of itself is a charity that you would set up, and you're the person who is in charge of granting the money from that charity or the donor advised fund to the ultimate charity recipient, whether it's a church or a school, some other places. But in this example, you might give $50,000 of highly appreciated stock. So going back to the Microsoft example, that stock has taken off over the last 10 years. If you sold it, you're going to pay a big capital gain. What if you gave the shares to the charity? And now we're going to give the next 5 years worth of giving. We're going to transfer the shares into the donor advised fund. And then over the next 5 years, we're going to slowly give out those shares, the proceeds of those shares, to the charities of our choice. So it's not as if you have to give it all to the ultimate recipient this year. You can still give over 5 years. The benefit is we're accelerating the tax deduction to this year because it's a higher income year for you. Again, I will leave you with this. I encourage you to consult with your wealth advisor to talk more about that. Okay, but time is of the essence if that is something that you're looking to do. Let's get to our first polling question of the day. Give you a chance to click on this here. Which of the following approaches to charitable giving is most effective? Giving cash, giving highly appreciated securities, or accelerating the next several years worth of giving via donor advised fund and donating highly appreciated stock? I'll give you some time to answer that one. Okay, nice job. Looks like 89% of you got it right. So with that, I'm going to turn it over to Liz Wilcom, who's going to talk about some additional individual tax planning strategies.
Thank you, Andrew. All right, today I'm going to start by going over what the benefits of this year-end tax planning can be for you at an individual level. When we're running tax projections at year-end, we're typically analyzing your current year tax position, so what's happened year to date and what we expect to happen for the rest of the year. At that point, we can then implement tax planning strategies before year-end, before it's too late. Otherwise, if we're just getting your tax data at tax prep time, before April, it's already happened. So we're just recording what's happened in the past year. There's not a whole lot that you can do there. While there are some strategies, the majority of the strategies really happen before year end. So the ability to look at where you are year to date and then look at what strategies might benefit you is really, important. We're able to accomplish multi-year planning by considering future tax rates and filling up low rate income buckets. I'll have an example of this, in a few slides forward. Reviewing withholding and estimated payment needs. So this is an opportunity for us to say, hey, your withholding might be a little off here. We think you can increase it, decrease it, or you'll need to make some estimated payments to avoid underpayment penalties and interest. And then, a big one here that people kind of overlook is just the ability to do cash flow planning, the visibility into what to expect, and really avoiding any surprises. It's not fun when you find out you have a big tax bill and you have to kind of scramble to get the cash together, right? So the ability to plan for that, set funds aside, and know what to expect in the future. When it comes to strategies, The most typical ones are either reducing and deferring taxable income. That's if you expect to be in the same or lower income tax bracket in the future, or accelerating income if the client is expecting to be in a higher tax bracket in the future. All right, retirement account. So Andrew already went through some of this, previously. So the limits are there for you in a graph here if you want to see those. But some of the strategies around this, you certainly want to try to max out your pre-tax retirement accounts, especially if the employer is making a match contribution. You want to make sure you're at least contributing that amount to get the free match. Deferring your initial year RMD. So this is an option, if you turn the age that you're required to take a required minimum distribution from your IRA, you do have the option to push that into year 2. But you should be aware of this because that means that you have to take 2 distributions in that second year. So if you knew that your income was going to be significantly down in that second year, you're retiring midway through the year or whatnot, in that year where you're required to take that distribution, pushing it off into that second year and filling up the lower tax bracket might make sense for you. Roth conversion. So this is something that we look at for clients if they are expecting to be in a lower tax bracket. So maybe their income's down for one reason or another. Pushing some of that income into the post-tax accounts for retirement can be extremely beneficial. So we're looking to fill up those tax brackets, those lower tax brackets in the lower years, and then that gives you the ability to take out funds, tax-free in the future, and all of those funds grow tax-free. So it can be very meaningful. And then qualified charitable distributions. So this is an opportunity, especially for the non-itemizers, to have a charitable contribution deduction where they typically wouldn't by making charitable deductions directly from their IRA. There are some rules around it, that you should certainly talk to your wealth advisors about. But if that's something where you're typically taking that standard deduction each year, but you're also charitably minded and you are giving to charity each year, you should consider taking this out of your IRA. One other item that I will mention here is a defined benefit plan. This is an opportunity that, if you are self-employed, you are able to really fund a retirement account and take a very large deduction, tax deduction. I think it's up to $275,000. There's a lot that goes around it, and the amounts that you can contribute are based on an actuary will actually do the calculations for you, but they're looking at the self-employment income that you have for the year, how long you've been in the business, and how to fully fund it. So it is an option out there that, people don't utilize quite as much, but something to keep in mind. All right, so next is itemized deductions. So, with the limitations on state and local income taxes being capped at 10,000, there's not a whole lot of wiggle room here as far as what you can do for itemized deductions. Really, it comes down to bunching your deductions, specifically with charity. And then, if you do have mortgage interest, looking at that. So as far as bunching deductions goes, Andrew's already spoke about the donor advised funds. If you are able to take advantage of the standard deduction in these years, you might want to consider making multiple years charitable donations in a single year. And that's where you can, consider a donor advised fund. And that way you're able to take that standard deduction in the future years. You're just itemizing once. So this is for the occasional itemizer. Again, the donor advised fund is an option if you're worried about, the charities not receiving funds in between years. Another thing to consider with making charitable contributions is if you are contributing appreciated stock to avoid capital gains. So if you do have stock that has appreciated significantly, so you have these unrealized gains sitting there, that would be a good item to contribute to charity, as Andrew had previously mentioned, because now you'll avoid those capital gains completely in the future. All right, so a few other miscellaneous items to run through here. Health savings account contributions. The limits are here for you. If you want to take a look at that for 24, they've gone up a little bit there. But this is something that I think people don't utilize quite as much. The HSA accounts can really be another retirement savings plan for you. Once you're in retirement, one of the largest expenses is medical costs. And so having those funds there when you are in retirement and when you are more likely to have higher costs can be really significant. And another thing to think about is that you can withdraw in the future for prior year expenses. So, maybe you're contributing to an HSA now and you're keeping all of your receipts, you're paying for your medical expenses out of pocket, not out of your HSA. You're letting that money grow tax-free. But you're keeping your receipts and keeping track of it in an Excel schedule or something. And then, 20, 30 years down the road, you need a large chunk of money. You can reimburse yourself for those expenses in prior years without having to create more taxable income. Accelerating installment sales payments. One more thing to think about if you do have an installment sales situation, that can be an option for you to accelerate into the current year. If you have the opportunity to arrange with your employer to defer bonus payments to next year, that might be a good strategy. And then if you do have a business, specifically like self-employment income with a Schedule C or some sort of pass-through entity, being able to defer some of that income or accelerate deductions could be beneficial. All right, and then some other planning considerations here for you. So the TCJA is set to sunset at the end of 2025. James Eaton will be going through, some of the ideas around the election and what changes might happen there. But currently that is still set to sunset at the end of 2025. So we are looking at that. IRMA. So this is the income related monthly adjustment amount. This is related to your Medicare premiums. And as your taxable income or your modified adjusted gross income increases, your Medicare premiums each month increase as well. So as we're looking through these strategies, we're certainly considering that, we don't want to push you into a higher monthly payment amount if we don't have to, right? So as we're filling up some of these lower income tax buckets, we'll keep that into consideration. And the same with Social Security benefits, up to 85% of those benefits will be taxable. But as we kind of increase the income in the lower income years, filling up those buckets and taking advantage of 0% capital gains rates, it can start to spit out more of the Social Security benefits that are taxable. So keeping that in mind. 83B elections, this is something, it gives you the opportunity to pay taxes now on the fair market value of restricted equity. So if you are receiving restricted equity, this is an opportunity for you to pay tax on this lower value now if you expect the value of the stock to increase in the future. So we see this a lot with startups. Maybe the fair market value currently is 0, but you are expecting that value to increase. Making sure that you file this 83B election it can be very meaningful because it means that in the future, when the value does increase and you choose to sell it, that income will be taxed at capital gains rates, which are more favorable versus ordinary. And then looking, if you do have a business, you're self-employed, you're currently a single member LLC, with a Schedule C on the books, does it make sense for you to convert to an S corporation status? And we look at this a lot for clients. Once your income is in that higher range, you do save taxes in several places, one of them being FICA and Medicare taxes, your Social Security and Medicare taxes. Since at an S corporation level, you are required to pay wages. You're able to pay yourself wages and only pay the Social Security and Medicare on those wages, not on the total income from the entity. A few other benefits that might, pop up here, the pass-through entity taxes and being able to pay taxes at the entity level, specifically for state taxes. If you're in Maryland, that's one of the states. You don't have that opportunity with Schedule C entities. So it's something else to keep in mind. And one other item is the qualified business income deduction there. So your ability to pay wages out may or may not increase your QBI deduction for the year, depending on what your income levels are. We look at married filing joint versus married filing separately. Most of the time, I'd say 90% of the time, married filing joint is the most beneficial, but there are situations where married filing separately can be more beneficial for the client. And where we see a lot of this is with that QBI deduction, again, the qualified business income deduction, because there are income limitations there. Maybe if one spouse has less income and they're not pushed into the highest brackets, they're not pushed over that threshold, separating them out from that return can actually get them a much higher qualified business income deduction. All right, and then I'll briefly mention disposing of passive activity losses to release suspended losses. So your passive losses are limited in general to your passive income year over year, and they're carried forward in the future until you either have the passive income or you dispose of the entity. So if you do have a passive activity like an investment in a LLC that might hold real estate, or maybe it's a business, but you're completely a passive investor and you're not actively involved in the management, and you have these passive activity losses sitting there that you have not been able to utilize, looking at years where you might have higher income and might be trying to reduce that higher income bracket, maybe it makes sense to sell that in that year, especially if you're already considering selling it. Looking year over year as to where that might make sense is certainly meaningful. All right, and then I wanted to give you a quick example. We'll go through this very quickly. So wages here in this situation, the client typically has wages of around 300,000. They have a large bonus coming in 2023. Self-employment's typically around 25,000 each year, and charity they're giving $12,000 each year. So if you want to go to the next slide, Andrew. What we would recommend here, or a few things we could recommend, accelerating those business deductions. So if they're able to take, $10,000 of additional deductions in the current year from their business, that would reduce the 2023 business income to 15,000. And then accelerating charitable donations. This might be through a donor advised fund, but if you see they're making 3 years of charitable donations here instead of the 12,000 each year. So they're actually able to itemize in the first year, and then they're taking the standard deduction in the following 2 years. So this is, these two examples here is going to save them around $8,000 in taxes over the course of the 3 years, which can certainly be meaningful. There are other things that we could recommend as well that would reduce this more, but I tried to keep this simple for time purposes. All right, and the last item is gifting and estate planning. So, one of the main things we're looking at here is taking advantage of that current annual exclusion, which is higher currently, and the lifetime exemption, also making outright gifts. So the lifetime exemption is set to expire. This larger amount is set to expire again at the end of 2025. We'll see where this all ends up with election results, but it is much higher now than it has been in the past. So something to consider with filling up those buckets. You can elect to treat 529 contributions as paid over 5 years. That means you could, contribute $90,000 to beneficiaries 529 and let that money grow tax-free if they are expecting, college expenses or higher education expenses. And it doesn't come out of your lifetime exemption because you're able to treat it as if it was done over a 5-year period. And it's just that $18,000 annual exclusion amount each year. Gifting from joint accounts might help you to avoid any 709 gift tax return filing requirements. And then finally, effective ways to give. So as you are gifting, considering, if you have highly appreciated stock, that might not be the best item to gift. That might be something better that ends up in the estate, because at the estate level, you do get a step up in cost basis. Whereas if you gift that item to someone, you are transferring your cost basis to the next person. So if, you're basically transferring the capital gains to that person in the future. So something certainly to consider there. Cash might be a better option. All right. So our second polling question, the annual gift tax exclusion for 2024 is it 15,000, 17,000, or 18,000? We'll give you a few minutes to answer here. All right, the correct answer is 18,000.
Wonderful. Thank you, Liz. Very helpful. We're going to transition over to the Corporate Transparency Act with Dan Gardrell. Dan, I'm going to turn it over to you.
Hello, everybody. Dan Gartrell here, tax principal with SC&H Group. Thanks, Andrew. Thanks, Liz. I am here talking about the CTA, Corporate Transparency Act today, and there is breaking news in this regard. Most recently, as of Monday, 12/3, the Texas Top Shop Cop Inc. versus Garland decision came out and actually gave us a preliminary nationwide injunction blocking the Corporate Transparency Act. The Corporate Transparency Act was enacted in 2021, and its goal was to combat tax fraud, money laundering, and the financing of terrorism. It is an information gathering reporting. There's no tax involved with it. It's an annual reporting, but based on constitutional grounds, courts, not only the Texas court, but also a court in Alabama, found that the law is unconstitutional. It exceeds Congress's enumerated powers, including its authority over foreign affairs, the Commerce Clause, the taxing power, and the necessary and proper clause. This recent decision in Texas Top Cop Shop, which is a great name of a case, is different from former decisions, which was the Alabama decision for the National Small Business Association, which gave the National Small Business Association an injunction, preliminary injunction. It only applied to the National Small Business Association. In this case, in the Texas case, this nationwide ban applies for all businesses, all reporting companies that were supposed to report their beneficial ownership reports and otherwise file with the Financial Information Crimes Network, FinCEN. So this decision, along with the Alabama decision, along with other appeals in the 4th, 9th, and 11th circuits, I believe, from various states, is likely heading toward maybe a Supreme Court decision where there's going to be some consolidation with the rulings, and there's going to be an ultimate finding, whether it's constitutional or unconstitutional, and Congress might actually have to go back to the drawing board. The AICPA in this regard has lobbied for a 1-year delay in the reporting. The reports currently are due, if you weren't aware before, by 1/1/25. So here we sit on 12/5/24, and the reports were due shortly. Advice in this regard is to confer with your respective legal counsel. It might be best to not procrastinate and just file now. And if you wanted to take a wait and see approach, you would want to gather the information now and be ready to file if and when the preliminary injunction is lifted. And of course, if you're taking that approach, you're going to have to be watching the court and be in touch with your attorney, be in touch with your CPA, and watching court proceedings to see if the preliminary injunction's going to be lifted. So although the Corporate Transparency Act is on the ropes and it's down, we don't think it's out. So my presentation will continue with some things that you want to consider as you are making your reports that might be less obvious to you, and you'll have time now with the preliminary injunction to potentially reevaluate a filing you've made or a filing that you're going to make. So single member LLCs, favorite entities for lots of businesses to do different operations, use it for liability protection, use it to own pieces of real estate, and are used a lot for deals and operate really as under companies or subsidiaries of many large operating companies. Regarding this, single member LLCs are not allowed and cannot rely on the large operating exemption when in fact you might think they could, because you are an operating company with 20 or more full-time employees, or you have gross receipts in excess of $5 million. A single member LLC that's actually disregarded is not really counted as being consolidated with the entity because it actually doesn't file a tax return. So single member LLCs that are disregarded would actually have a filing requirement and could not rely on a large operating exemption or really any other exemption you might have been filing under and would have to report. So this is a case that we see quite frequently in our business where there's many operating disregarded entities, and you can't just, because you're a large company, not report for those single member LLCs. What this really means is if you're a large operating company, right, you're going to have a report for your large operating company, and then you're going to have additional reports for all those single member LLCs underneath of your operating banner. This is something that guidance has continued to come out about, but a lot of folks, I think, are probably not thinking about these single member LLCs and might be falling into this assumption that because they're a large operating company or another exempt entity, that they do not have to file. So if you have a single member LLC, this is something you definitely want to double check and examine and potentially take action to file for the single member LLC in your organizational structure. So single member LLCs don't usually have EINs, and in that regard, that's not a problem. Single member LLC can actually use its parent EIN, or if it's owned by an individual, the individual social security number. SSNs, ITINs, taxpayer identification numbers, there's a lot of jargon in there. I think most folks are familiar with employer identification number. Tax identification number, a TIN, is often acquired by foreign entities. And obviously, social security number can be used in place when you do not have an employer identification number or a TIN. One thing that is evident here is that you actually could have many of these companies being reported under the same TIN or EIN number or social security number, and that's okay as long as that's the correct owner of the entity. One thing here is if you can avoid using your social security number, a lot of folks do not want their social security number floating out in the ether. So you want to make sure maybe if there's an opportunity, you can use an EIN or an ITIN or a TIN number if it is more applicable as far as that ownership goes. Updating your BOI report. One of the reasons that the Corporate Transparency Act is so problematic is that if you have changes, you have a very limited amount of time in which you can make those changes. So 30 days is the magic number when you have had a change in beneficial ownership. And remember, beneficial ownership can be a 25% owner or anyone who's in substantial control. So board members, LLC managers, trustees, if it's a trust that actually has a reporting requirement, all of these folks would end up on one of your beneficial information reports. And if you have a change in that position, you're going to want to make sure that you update that and change your beneficial owner report within that 30-day window. What this highlights is that you really need to have a person in your company who's responsible for this. You want to have a policy in your company that actually requires this. And in some cases, you're going to want to make sure you have standing authorizations from maybe officers, directors, managers that you can disclose their information to FinCEN just to make sure everybody's on board and understands what the reporting requirements are. 30 days is a short period of time. As tax practitioners, we don't often see your information, maybe biannually or quarterly or at the end of the year, and 30 days, it might be missed. Another place this comes up is M&A transactions. So once the deal is done and everybody is happy with the transaction, you will probably end up having to update the BOI reports, and hopefully somebody at those tables, those settlement tables, has that on their checklist. Subsidiary exemption or a trap. This is another nuanced area of the Corporate Transparency Act, and it's called a trap because a lot of times, same with single member LLCs, you might be under the impression that you do not have to report a subsidiary if you are a subsidiary of yours, if you are in fact exempt from reporting. So regarding this, you could have an entity that's exempt, whether it's a not-for-profit or maybe a bank or another financial institution that has a sub-entity, and unless that entity is wholly owned, meaning it's not a partial interest, that entity itself might not be exempt. So this is another, again, nuanced area, and there's not a lot of guidance out there. FinCEN really hasn't defined control for purposes of the CTA subsidiary exemption. And this ambiguity in this regard means that when in doubt, file. So if you have a subsidiary that you do not wholly own and you are otherwise exempt, it would probably be best to just simply file to take this off the table. Not-for-profits, again, anybody that's on our large exemption list would be entities that you would be looking at this for and making sure that you have your compliance there. And again, subsidiary exemptions, I think, give people maybe false comfort, and you might not be looking at it as closely as you need to. So exemptions, refresher, these would be the entities that might actually, some of these entities anyway, might have a subsidiary that would fall into that subsidiary trap. Two on here that we always highlight are the large operating companies, more than 20 full-time employees, $5 million in gross receipts, physical office in the U.S. One thing I would note here with this exception is that you can fall in and out of what is an annual determination. So again, you would be required to report within 30 days of falling out of this exception. So something that you really need to keep an eye on if you are right on the cusp of saying you have more than 20, so you have 21 full-time employees, maybe you made $5 million in gross receipts the year before, you would be one that you might fall in and fall out, and you have that same duty to file. Inactive entities is another one that comes up quite often. Again, can't be foreign owned, not sent or received funds greater than $1,000 and no assets. Same idea here as I just mentioned with the large operating companies. If you could fall in and out of this exception, because you might have an entity that you set up to do some kind of business and you didn't use it, but then maybe you start using it. I think with funds received greater than $1,000, a lot of folks think about rental properties, but rental properties, of course, would have assets. So rental properties would not meet this exception. But if you are even maintaining an entity, perhaps for some future activity, you would be looking at potentially having assets in it. And this would be another one that, again, you would want to have a person in your company and a policy in your company that would be monitoring these entities and monitoring their activity so you could comply with that 30-day window. This is the law as it was before 12-3 case, Texas Top Cop. Entities that were created on or after 1/1/24. You were not, or on or after 1/1/24, you were required to actually report company applicants. So right now there's obviously a preliminary injunction, but any new entities, not only are you required to report the beneficial owner's information and the entity itself, the applicants are also required to be reported. So again, this could stretch to any kind of clerk, secretary, or anyone in the company who's actually helping and filling out the application on FinCEN, including lawyers, CPAs, anybody, that their information would actually have to be reported. So companies that were created before January 1, 24, there was no reporting for that. So again, just a little nuance in the law is that if the company is newly created in 24, you're going to actually have to report the company applicants. And if it was before, you did not have to. One thing, if you're thinking about creating a company presently, you might consider creating it in December of 2024 versus January of 25. The reason I say that is that you have 90 days if the company is reported in 2024 or company is created in 2024, you have 90 days to report versus if you created a company on 1/1/25, you would only have 30 days to report. So if you have a transaction or you're going to need a new entity in 25, it actually behooves you to create it now to get that extra 60 days and perhaps even take advantage of the wait and see approach on whether the preliminary injunction is lifted or what happens with the Corporate Transparency Act. I think procrastination is generally a bad thing to do. And if folks have already filed their FinCEN reports, I would not worry about how the law is changing, and I would only worry about updating when necessary. I think there's going to be a lot more that comes out with this. We do expect that the DOJ is going to appeal, and it might be some time before there's actually a decision. So if you're going to, again, take the wait and see approach, I would be ready to file when the preliminary injunction, if and when the preliminary injunction is lifted. So polling question. I'll leave it up here for you guys to answer. Take a couple seconds and see how you do. A little bit of trick there. It's actually more than 20 employees, but most people are on the number 60%.
Thanks, Dan. Okay, we're going to switch gears a bit and go over to Zach Landon for some business tax planning opportunities.
Awesome. Thank you, Andrew. So I'm Zach. I'm a tax principal here. I'm going to be talking some business tax planning, some of the kind of low-hanging fruit, kind of the easier items. Business tax planning is certainly catered to each of your situations. So I'm going to try to talk about some of the very general ideas, but, reaching out to your advisor to discuss, more specific and some other items is certainly something to do. And, as Liz said, a lot of these things usually have to happen before the end of the year. So with, a couple of weeks until the end of the year, now's the time to really start thinking about this. So first up on the slate is kind of changes from 23 to 24. Luckily, there's not a ton. I feel like we went through years of a lot of tax law change, and the past couple of years have been business as usual for the most part, but there are a couple of things to note. Bonus depreciation, 60% has dropped to 60% of the basis of the assets compared to what was 80% in 2023. This is for qualified property. It's going to drop even more in 25, 26, and 27. James, we might talk a little bit about what may or may not happen with, election updates. So I guess the answer here is this is how it currently stands under current law. Stay tuned for anything that, comes through in the future. Section 179 is also another item in there. So it's kind of similar to bonus depreciation. It's if you have less qualified property placed in service, it changes a little bit. It's basically bonus depreciation in Section 179 is being able to accelerate depreciation on certain fixed assets. Want to make note, don't go out there and, buy autos and whatnot, as that is, has special limitations. So whatever you're buying, make sure you reach out to your advisor to make sure that it falls into one of these two categories and we can accelerate depreciation if that's what we want to do. We're going to talk about a little bit of timing of business deductions. Liz was talking about filling up these kind of lower brackets earlier. So it's kind of what we try to do from a pass-through. So this kind of applies to S corps and partnerships, since that income is going to flow through to the individuals. So we like the plan of looking at and trying to fill up some of those smaller tax brackets at 0 to 24%. So if we have a business that can fill up the income up to, the 364,200 for married filing joint, we try to do that and keep income, instead of saying, let's zero out income to a 0, let's make it in a more reasonable tax bracket. Nobody likes paying taxes, but I'd much rather pay it at a 24% instead of having that income be taxed at the, the highest tax bracket at 37%. If we can do some tax planning. Some of the tax planning kind of comes into, if we know we're going to be close to that threshold, can we pay some expenses? If we know we're in a lower tax year, Do we want to accelerate income a little bit to kind of fill up those buckets? Or from the opposite end, say we're sitting at $500,000 or so, can we do some tax planning to knock down $150,000 or so to kind of play the rate game of being taxed in a 24% tax bracket instead of that jumping up to where all that income's taxed at a 30 or 32%? They're still graduated, but it still brings you down into a lower bracket. And obviously, strategy should be evaluated every year based on each of your individual tax situations. Let's talk about some of the common ones here. So some of the common ones that I think everybody, kind of we talk about is year-end bonuses. So cash basis, if you're in a high tax bracket, and you want to take advantage of the bonuses that you may pay employees, you got to make sure that it's paid by the end of the year to receive the deduction. Let's say in 2024, you had a down year, you're in a lower tax bracket. Does it make sense to sit there and say, we want to pay bonuses, we still have a little bit of bonuses, but does the timing of those payments change? Instead of paying them out at the end of the year, do we defer them until, early 2025 when we think income will go up, which is obviously going to have a better effect to take a deduction in a higher income tax year? Accrual basis, you deduct the bonuses in the year that all events test related to the bonus are established, and you have to pay it out within 2.5 months after year end. Want to note there's a couple special rules for officer compensation. You can't accrue a bunch of officer compensation and take that deduction, so be careful there. And then also timing of these bonuses. Say your accrual basis, you're in a lower tax bracket. Do you want to push it past that 2.5 months to where you necessarily don't get the deduction in 2024 and you have to push it to 2025? All in all, that kind of, you have to look at your current situation and determine, does that make sense for me and for my business and what's flowing through to the shareholders or partners? So that's kind of a business by business, but there is some room for accrual basis payouts of bonuses of when they can and cannot be deducted. A couple other items for accrual basis. Probably one of the not as known, but I still think it's somewhat popular, is a 12-month prepaid expense rule. It allows the deduction of prepaid expenses in the current year if the right or benefit paid does not extend beyond the earlier of 12 months after the right to benefit begins, or the end of the following tax year in which the payment is made. There are some rules of what can and can't be paid in this, but basically the way you look at this is certain expenses, you can make an election, or you might have to follow a certain form to make this election, can also be treated as prepaid expenses, treated as cash basis instead of accrual basis. But as I said, there are some rules that go into what is allowed and what's not allowed. So talk with your advisor on that. Some cash basis, just some of the low-hanging fruit that we like to talk about, health insurance, software subscriptions. Is there certain things that can be prepaid at the end of the year so we can receive the deduction? Do we have some vendors in AP that we can pay down by the end of the year? Don't go, prepaying vendors for which haven't performed service, or you don't think you're going to perform service, or you have questions about because just to save tax dollars, but does it make sense to, prepay some vendors for things? And just want to note, if you pay down debt, you pay distributions out of a partnership or S Corp, and then credit card payments is another kind of weird one. Credit cards, whether you're cash or accrual, is allowed when you actually swipe the card, not necessarily when you pay the card. So if you have a large credit card balance and you say, I'm going to get a deduction and pay that down at the year end in your cash basis, that's not going to lower your cash basis income. Let's talk about a couple different entities here as far as what we may be. All these kind of things are not subject to C Corps that we were talking about. From some of those deductions do, but some of the, keeping the tax brackets together is related to flow through. Most of that we see is, the partnerships. So as a partnership, a partner share your losses, the deductible only to the extent of the partnership basis at the end of the year. So most of the time, you can look at your K1 and see what the basis is, reach out to your advisor and say, I'm going to have a bunch of losses or gain. What can I do? You can increase basis by, giving capital contributions, the partner borrowing money, or you can allocate partnership liabilities. And there's some rules there of who guarantees debt and all that if you want to take a debt basis. So there's some issues there. If you have a huge loss and you don't have basis, it's possible that some of those losses may not be recognized in the year that they happen if there is no basis. S corps are a different animal. Shareholders deduct its pro rata share of losses only to the extent that there's basis in the S corp stock. The determination is made at the end of the year of the S corp in which the loss occurs. If you don't have basis, and kind of the weird thing is here, say you go to the business and you have a line of credit that you take out, you don't necessarily get the basis in the S corp to be able to take that line of credit as basis. So that's usually when we run into issues where we're having distributions in excess of basis, or we have unallowed losses. So if all of a sudden you run into basis limitations, it's possible that you don't lose those. However, they're carried forward indefinitely until you have business income that can help offset. Be careful with 461 losses. So 461 is a code section that basically limits the total amount of trade or business loss that can be done. It's in the mid 500s as far as what's going on. So say if you have an S corp, it had a large loss year for whatever reason due to operations, and it's $1.5 million. Say you filed a Mary filing joint return, it's only going to limit you on your individual tax return to only be able to take 550 of those, and then those losses carry forward. So be careful with thinking that you have a very large loss. That yeah, I can take all this and maybe I'm going to convert $1.5 million of Roth IRAs might be a good way to utilize that. You got to be very careful with the 461 limitations to make sure that we're offsetting income and that we're not limited in carrying them forward. Qualified business income deduction are one of our favorite topics here. Through 2025, it's 20% of the business owner's qualified business income. It's subject to limits when the owner's income reaches certain levels. I put some numbers in here, but it's basically $385,000 for married filing joint taxpayers. If you're a specified service trade or business, entities that are not a specified service trade or business and are actually a qualified trade or business, you then, once you go above that income threshold, we have to start looking into W-2 wages that are paid, not just the owners, but to the employees. You also get phased out if you're a SSTB. If you're single, most of those things usually get cut in half. But if you're not a SSTB and you're a qualified trade or business, and you're going to be above that threshold, we want to make sure that we have enough wages, or can we do some compensation planning at the end of the year to be able to utilize the wages to make sure that we're taking full benefit of the qualified business income deduction. It is scheduled to go away after 2025. So are we near the threshold? Can we accelerate deductions, defer income to take good benefit of this pending no changes, which I guess, as I said earlier, we're going to have to wait and see how everything works from a legislative point. And then also one of our other favorite deductions, and I think this has been probably in our slides for the past couple of years and then around the same chart, but this is probably one of the better charts that summarizes this. This was updated in May. 2 or 3 years ago, this was being updated every 3 days. But just taking a look at this chart, and I'm not going to go into each state, but it's basically 36 states in one locality have what they have as a pass-through entity tax. Our neighboring state up to the north of Pennsylvania has a proposed kind of legislation right now. They've had that for the past year or two and have different versions of that. So I wouldn't hold my breath on Pennsylvania being into the PTE. But I think what you got to gauge from this map is there's very few states that have not enacted PTE. So it is a very good planning opportunity to take advantage of. And I'll talk a little bit about what the PTE is on the next slide. So. All right, so the state income tax deduction, the PTE workaround, I think as we discussed, the $10,000 SALT limitation, what this kind of did was bring states in and say, we know business owners are not necessarily having the best benefit of being limited to $10,000 of deductions on their Schedule A. What we're going to do is this is a workaround to where they're allowed to take the deduction at the entity level, which will then flow through the individuals, and it kind of circumvents that $10,000 limit on the Schedule A. What happens to that $10,000 SALT limit? We don't know what's going to happen or not happen. So this is kind of the way to keep it into effect and keep getting around it. Generally, both federal and state income tax passed through to entities is paid by the entity's owners. and I said, due to limit, we can't do that. This is the workaround. 36 states, some pitfalls that I want to mention. States have different timing of elections. So states, the problem states that we call them, states like New York, California, New Jersey, some of them have to where you have to make the election and go on the website by a certain date. And some of those dates have passed. California, you have to pay in a certain amount of the tax by, I think it's June 15th of this current year of 2024. New York, you actually have to go into the website and make an election. It's not just a checkbox. And a couple other states have the same issues. Some other pitfalls that you really got to do some planning. It sounds like this is a slam dunk and that we should always do it. But if there's multiple owners in different states, you kind of want to look at it and make sure that it makes sense for everybody. Usually if they're individuals and say it's an S Corp and 2 owners and they're in the same state, it almost always makes sense to do the PTE, but that's not always true. So you always want to look at the PTE to kind of get around that $10,000 limit. And then just be very careful with estimated tax payments. Maryland has a checkbox on their voucher to where if that checkbox is not checked, that is a revocable or irrevocable election, to where if that checkbox was not checked with the payment, unfortunately, you don't get to take the PTE election this year. So you just got to be very careful with making estimated payments, determining what payments are doing. And as you know, as advisors here, we look at all our states individually and look at the owners and kind of look through everything to make sure it does this or does this not make sense for the individuals as a whole and the final ending taxpayer. Okay, that brings us to polling question number 4. What state has enacted the pass-through entity level tax? Pennsylvania, Delaware, or Maryland? So on this, Maryland is the correct answer. Unfortunately, Delaware and Pennsylvania and DC are a little far behind on enacting the PTE.
Maybe they'll get something done in the year to come. Thank you so much, Zach. Appreciate your time. Next up, we have James Eaton to cover post-election update and what's next.
Well, thanks so much, Andrew, and thank you, Zach. I'm James, and we're going to talk about, so this is very important. First little disclaimer here. We're going to talk about policy for a few minutes, but we're not going to talk about politics. And I think that's an important distinction to make. So after the November elections, we're seeing sort of headlines that say that there is a Republican trifecta, which is the idea that the Republicans control the Senate, the House, and the White House. And so one might think that means they can pass anything they want to, but from a sort of a legal and legislative outline point of view, they still have to use a reconciliation approach to passing tax laws. So it's important, and it puts some framework around what we can do, what we can't do, what we expect to see in the next few years. There's also an interesting sort of aspect of this that people are starting to work their way through, which is that the most recent analysis by, I don't know, folks way smarter than me, is that we're likely to see 2 tax bills in 2025, which is not super common. But it looks like there may be a tax bill in the traditional kind of first 100 days kind of timeline, which will deal with some things. And then some of the more technical aspects, we'll talk about those for a few minutes, but some of the more technical aspects may be in a bill that's after the September 30th fiscal year end, so that it goes into the next fiscal year. So some of those machinations that work around what we expect to see from tax policy. Great. So there are a whole raft of expiring tax provisions which were passed under the Tax Cuts and Jobs Act, and which we dorky accountants call TCJA. And we'll see, there'll be slides full of them. Literally, there will be slides full of them. You can read them all. And we'll talk about a few of them. But broadly speaking, we anticipate that since the first Trump administration passed most of these provisions, we anticipate they're going to want to extend them. And that's been backed up by public statements. So what are some of the important ones that we've seen from a tax planning perspective? Well, back in 2017, when they passed the original Tax Cuts and Jobs Act, TCJA, the tax rates were lowered. Many tax rates were lowered. 15 became 12, 25 became 22, 28 became 25, and that's important. So, and you'll see here, the first bullet point, hey, the highest tax bracket will go back up from 37 to 39.6. That's certainly meaningful for folks in the highest tax bracket. There are a lot of folks in those middle tiers, middle income taxpayers, maybe in that anything from $200,000 to $400,000 tax bracket, where there are really meaningful changes in the 22 becoming 25 and the 24 becoming 28. And also those tax brackets were taller. So for middle income families or families making $100,000, $200,000, $300,000, $400,000, these types of changes represented a $6,000 to $10,000 tax increase on an annual basis, and that's meaningful to a lot of families. So those are the types of things that we anticipate being extended, right? Nobody in the modern political world wants to be the party of increasing taxes. Another one that's been super helpful to many of our clients in the pass-through space is the qualified business income deduction. You heard Zach talk about that in some detail just a few minutes ago. Again, we anticipate that would be extended, and that's also interesting or important to remember that was sort of the flip side of the coin to the decreases in the corporate tax rate. So Congress looked at bringing the corporate tax rate down from the high 20s to the low 20s, and they said, well, if we do that, we also have to make some kind of benefit for smaller family-owned businesses. So that's what we see here. A big one for many folks was the standard deduction. Again, that would be cut back to where it was a few years ago, essentially cut in half, and that's when we fully anticipate will be extended. And then the sort of political hot button issue from 8 years ago, really, is the SALT cap and the state and local tax deduction cap. So we've seen a lot of numbers here. So for a frame of reference, the first 8-year run of the Tax Cuts and Jobs Act was programmed and budgeted to cost about $1.9 trillion in essentially deficit spending. And we've seen numbers that say, hey, to extend all of these things would cost another $3 to $4 trillion, which just, again, for frame of reference, that seems like a lot to you. It is. The French government just in the past day or so has collapsed under the weight of a $60 billion deficit, which is 1.5% of the numbers that we're talking about here. So interestingly, going back to 3 to 4 trillion, that seems like a lot. Taking the SALT cap 100% away, just doing away with it, we've seen numbers that say that could cost another $1 trillion, which might bring the overall cost to something like $5 trillion. It's a lot. So that's one where it'll be interesting to see what the actual budget scoring comes in and how does that work. And let's just scan through. We'll look at a few of the other considerations. Miscellaneous itemized deductions and mortgage interest limits. So those are things that, again, we expect to be extended only because while all politicians would love to give us additional benefits, we have to pay for some of this stuff as we go along. Yep, there we go. And again, here are some of the other considerations, like the PEAS limitation, which limits the amount of itemized deductions a person can take, personal exemptions, child tax credit, all very meaningful and important considerations. The last two are super important, so it's very easy to forget that there used to be this thing called AMT, the alternative minimum tax, and that was this idea that some of your deductions were too much. There was a limitation where you weren't allowed to take so many benefits for tax deductions. And so the biggest add back to that was the state and local tax deduction. So while it might be great to have uncapped state and local tax deductions, we would expect many of our clients to then be subject to the alternative minimum tax, which takes away a whole lot of that benefit. So it's a little bit of a trade-off there. And then also the current estate tax exemption for someone passing away today is around 13.6 million. And that would revert to being about half of that under if the TCJA were left to be come to the sunset at the end of 2025. And that's one that's likely to be extended. The business provisions are also really interesting, and for those business owners or folks in kind of executive management for businesses, you may have heard some of these things, right? So over the past few years, research and development expenses have been required to be capitalized rather than expensed. And what that represented is a really important and sizable increase in taxes on an annual basis to early stage technology type companies, biomedical type companies. It's really hurt the research and development space. And so there is bipartisan support for extending the immediate expensing. But again, somebody has to figure out how to pay for it. Again, and we try not to do code sections here, but you'll see interest deductibility under IRC section 163J. There was a change in the definition of whether or not we get to take depreciation and amortization out of that math. That's one that a lot of pro-business groups are pro for. One that President-elect Trump has talked about for years is an emphasis on immediate expensing of capital expenditures, so 100% bonus depreciation. Again, Zach just told us a few minutes ago that if you go out and buy a $100,000 widget, right, for your business, you only get to take immediate depreciation on $60,000 of that, and you have to take traditional depreciation over a longer time on the balance. So there's a lot of move to spur spending in the industrial space by increasing immediate depreciation. And then we have some really sort of technical issues around foreign derived intangible income, FDII and column 2 and all these sorts of things. Michael will talk to us more about those things in just a few minutes. And then the one thing we probably won't talk about are tariffs, which I think are ostensibly taxes and are ostensibly, to some degree, managed through the IRS, but they're not income taxes. They're not something we normally see. They're more of an input cost. So another thing that has been talked about quite a lot is, hey, do we want to bring the corporate tax rate down lower? For folks like Andrew, this is a great thing, right? Every time we bring the corporate income tax rate down, stock values go up because there's more cash to be either reinvested in a business or distributed via dividends. So that's great. And folks have talked about a decrease to 20% or 15%. It's easy to forget that it seems like just 3 months ago we were talking about, well, what if they increase it to 25%? Interestingly, and again, I'll remind you, policy, not politics. There are some congressional members who actually worry about having to pay for all of these things. And there's some reticence to further cut corporate tax rates in a scenario that results in additional deficit spending with worries for long-term economic, I think there's a statistic that says 1 in every $5 spent by the U.S. government this year will be on debt service. So there's a lot of debt. Great. So what other campaign tax promises have we heard about? Do we think about? Again, TCJA was expensive. Extending it will be more expensive. Anything we add on to bring taxes down will be even more expensive. And that will be, I think, part of the conversation. It may be, again, if we go back to that first slide and think about passing a more simple act early in the year and then a more complex act later in the year. And there's some retroactive considerations around some of those things like accelerated depreciation and research and development, and whether we want to retroactively pretend as if the law was more beneficial and give people a chance to true that up, or whether that's too expensive. So that's some of those more technical things we're likely to see later in the year. We'll likely see additional support for American manufacturing. We've seen a number of these sort of bills that say, hey, inputs, whether it be steel or whatever it would be, needs to be American made in order to qualify for one benefit or another. So we're likely to see those sort of things. And I think it's broadly considered that the 100% bonus depreciation, the immediate expensing of acquisitions, is seen as beneficial to manufacturing and American industry. And there are a number of new tax cuts that have been proposed, and those are a little bit trickier. Exemptions on tip income, or exemption from Social Security, and deduction of auto loan interest are all new things that might be a little bit harder to pass. So I think, what are our takeaways? Sorry, Andrew, go ahead. What are our takeaways? The core provisions of TCJA are likely to be extended. Some of those retroactive cleanup items are a little bit less likely to be extended. Changes to the corporate tax rate are likely to be kind of a negotiation point in that discussion. The PTE, that the Pass-Through Entity Taxation Act, told us about, likely to stick around. We expect a focus on U.S. manufacturing, and tariffs are sort of new territory. So I think that's what we've got, Andrew. Great. So polling question number 5. Which of TCAJ's provisions is most meaningful to you? The 20% QBI deduction, the SALT deduction, corporate tax rate, or R&D expensing? Oh, cool. Very interesting. I think we see some individual taxpayers and business taxpayers, and those concepts being, and different concepts being important to different people.
Thank you, James. Mr. Bondi, no pressure, but we only have a couple of minutes for corporate tax planning. Do your best, sir.
Okay. All right, I think you have to take me off. Allow my video. There we go. Okay, so I'm Michael Bondi. I lead the firm's C Corporation income tax practice. And with the very short amount of time we have left, I just want to touch on some well-known but still very relevant concepts that tend to be hot items for our clients. James already touched on what we call Section 174, the amortization of research and experimental expenditures. This continues to be an area of frustration and sometimes surprise. It's still a relatively new concept. We're in year 3, but something to be mindful of as we walk into year end and as we start thinking about, our position. Maybe we had a book loss. Maybe it's R&D expenses or R&E expenses that are driving that. Let's not automatically assume that, this is putting us in a tax loss position and we don't have to think about taxes for the year. So it's something just to remain mindful of. We also want to continue to remain mindful of, it was touched on a little bit earlier, was either Dan or Zach, bonus depreciation. So for fixed assets placed in service with a useful life of longer than 1 year, we've gotten very used to full expensing or major expensing of those expenses, those otherwise capitalizable costs. Bonus was reduced to 80% in 23. It's further being reduced to 60% in 24, scheduled to decline further to 40% in 25, 20 and 26, and then 0 for 27 and beyond. This is, again, let's circle back on what James talked about a couple of minutes ago. All of this is subject to change. We're new governmental regime. We don't know where this is going to go. Could we see a restoration of full bonus depreciation? Potentially, but we act on what we know, what's enacted as of year end. We act on what we know at this time. Let's think about R&D. Let's think about bonus depreciation and the changes that are coming. Changes to the GILTI tax rate, which are noted above. There's less value in these deductions coming across. So important to have this as a live conversation. I think we have a polling question coming up next. And we'll just take a real quick look. Give folks another couple seconds. I think we can wrap that up. Okay, so most folks have got that right, which is a good thing. Again, at least the expectation is, absent any law change, this is the direction bonus depreciation is headed. Moving on to a new accounting standards update. So there's been a demand from the financial statement user requesting more transparency about tax information. income tax information reported in its financial statements by improving income tax disclosure. And this is something that's, the effective date is noted on the slide. And what we're doing is requiring a company to disclose specific categories within its reconciliation between the amount of reported income tax expense or benefit from continuing operations and the amount computed by multiplying the income or loss from continuing operations before income taxes by the applicable statutory federal income tax rate of the jurisdiction. Said differently, if my pre-tax book income is $10 million, we need to explain why my total tax expense is not exactly $2.1 million, 21% of 10 million, which is the Fed statutory rate, which it almost never is. So this just is going to require more transparency, and it's going to lower the threshold for that transparency to anything greater than 5%, any line item reconciling tax expense of greater than 5%. Of note, prior to the adoption of the ASU, public companies have been required to disclose reconciling items in amounts or percentages. It was your choice. It was an election. Now the ASU requires disclosure of amounts and percentages as well. There's a lot of nuance around this as well, but it's something to be mindful of as we go forward. Last thing I want to touch on is just Pillar 2. Pillar 2 is a fairly complex subject. I had quite a bit of information to share with you about it. It only applies to large multinational entities, companies with consolidated revenues exceeding 750 million euro, and it acts as a top-up mechanism where a company's tax liability is adjusted if its effective rate in a country or jurisdiction falls below 15% in that jurisdiction, with the intention of contending with tax planning strategies implemented by those multinational corporations, with the intention of paying zero tax in certain jurisdictions. It's constantly evolving. 45 countries either have introduced draft legislation or have adopted final legislation incorporating Pillar 2 rules into their national laws. Another 10 intend to. Notably for us, the U.S. has not moved in that direction. Republican Congress has no interest in pursuing this. It's going to cost the U.S. too much in tax revenue. It matters to us because many of our C corporation clients are multinational entities that get close to that threshold or are above the minimum threshold and report in the U.S. And this potentially impacts the company's income tax provision for interim and annual financial reporting. So while the U.S. may not have adopted Pillar 2 and does not intend to, if the company is subject to it, we have to report it. And there's a lot of nuance around that, but running short on time, actually running over time, want to leave some time for questions. Please feel free to reach out, hear a little bit more about it, listen to a little bit more. Thank you for joining. Andrew, back over to you.
Thank you, Michael, and thank you to all of our clients and other friends who were on this call. We appreciate your continued confidence in our ability to serve you the way you deserve to be served. With that, we're going to wrap up here. I know we have a Q&A. We do know who submitted questions. We're going to be reaching out to you directly to answer those questions for you one-on-one. So again, thank you so much for your time. Stay warm, everyone, and I hope you make the best of this year's holiday season.